The morning begins like any other. You pick up your phone. The stock ticker flickers gently in red and green. There is no urgent news. No bold breaking news headline jumps out at you. Everything looks normal, suspiciously normal. Out there, people are still going to work, still paying their bills, still complaining about credit card interest rates, about home prices, about rent rising month after month. On television, experts debate whether the US economy is experiencing a soft landing or not landing at all. No one is shouting, no one is panicking, no one is running. But something is happening quietly, silently, like water slowly rising behind a dam. Within just a few months, a massive amount of money will begin flowing into the US economy. Not in the form of a collapse, not as an emergency bailout, and not by helicopters dropping cash onto the streets, as people have seen before. This time, it arrives through schedules, tax schedules, refund schedules, corporate capital repatriation schedules, depreciation schedules, investment schedules, and dry lines of text buried in policy documents that most people have never read all the way through even one page. It sounds harmless. It sounds technical. It sounds not worth worrying about, and that is exactly why it is dangerous. Because history shows that the biggest changes in markets rarely begin with an explosion. They begin with silence. They begin when most people are still busy debating whether anything is even happening, while the flow of money has already quietly chosen where it will go. There are no scenes of chaos, no crowds running in all directions, just accounts being quietly topped up, balance sheets being polished. And those who are standing in the right position begin moving ahead without having to raise their voices. The question is not whether this will happen. The question is, when it happens, where are you standing? And to answer that question, we need to say one thing plainly from the very beginning. Let's be clear from the very beginning, to avoid any misunderstanding. This is not a video about politics. It is not meant to praise or attack any individual. And it is not intended to predict whether the market will go up or down on any specific day. What we are talking about here revolves solely around capital flows, where the money comes from, when it arrives, and what it typically does whenever it appears on a large scale. The central argument is very simple, yet often overlooked. When money arrives according to a schedule, markets always move before the majority realizes what is happening. The winners are not those who react quickly when the news hits the airwaves, but those who understand the sequence of capital flows and position themselves correctly before the money moves through. If you wait until financial news programs start talking about a wave of tax refunds or growth stimulus, then the easiest part of the opportunity has usually already passed. Markets do not reward attention. Markets reward preparation. And to understand why this repeats itself again and again, we need to look at the part of the story that very few people explain clearly. If you follow financial news every day, you will hear a great deal about taxes, about tax refunds for the public, about incentive packages for businesses, about growth stimulation, job creation, and figures that are delivered very smoothly, very harmlessly. But there is one important detail that is often glossed over. Not because it is secret, but because it is not attractive in headlines. The detail is timing. The media usually talks about policy. The market reacts to schedules. Those two things are not the same. A piece of legislation can be signed today, but the real flow of money may only begin to move months later. And in that gap, everything that matters most has already taken place. This is the part they rarely explain clearly. The market does not wait for the money to arrive before it moves. It moves when people believe the money is about to arrive, when large institutions, funds, and trading desks begin repositioning themselves based on what will happen, not on what has already happened. It may sound hard to believe, but if you look back at history, you will see this repeated over and over again. When CNBC begins talking about a wave of tax refunds, most of the smart money has already moved ahead. When retail investors start asking, should we get involved? Those who prepared early have already begun thinking about taking profits. This is not because they are smarter or more ethical. It is simply because they are playing a different game. They do not wait for clear signals. They read faint signs, dry documents, and details that most people consider boring. One slightly uncomfortable truth is this: most investors are trained to react, not to anticipate. We are taught to wait for confirmation, Wait for the data. Wait until the market becomes clearer. But by the time everything is clear, the advantage has already disappeared. And that is why, to understand what is about to happen, we need to quickly look at the big picture. Who is involved, where the money is going, and who will end up paying the price for this delay. Before we go any deeper, we need a simple map. Not to predict the future, but to avoid getting lost once the numbers start appearing in dense clusters. Who is creating this story? Not a single individual, and not some secret group either. This is the result of a combination of tax policy, American corporations, and tens of millions of households. Each party acts in its own self-interest, but when combined, they generate a flow of money large enough to bend the entire market. What is happening? Approximately USD 4.7 trillion will be injected into the US economy in less than 9 months. This money does not appear all at once, but in waves: tax refunds for individuals, corporate funds repatriated from overseas, and incentives that encourage businesses to spend immediately rather than wait. Why does this matter? Because that figure is equivalent to roughly 20% of the size of the US economy. In modern history, it is very rare for such a large amount of money to be released over a short period of time without leaving clear marks on asset prices. And who will pay the price? Not in the sense of a collapse or a crisis. The ones who pay the price here are usually those standing in the wrong position, those who hold cash for too long, those who wait until everything is spelled out clearly in the headlines, and those who believe the market will give them plenty of time to react. Capital flows always have beneficiaries and those left behind. They have no morality, they have no emotions, they simply move along the path of least resistance. And to understand that path, we need to dissect this flow of money layer by layer, rhythm by rhythm, wave by wave. To understand why this USD 4.7 trillion does not explode all at once, but instead exerts a prolonged impact, we need to abandon the familiar way of thinking that money entering the economy is a single event. In reality, it operates more like a chain reaction. Each step clears the way for the next. Each wave creates the conditions for the wave that follows. And if you miss one beat, you do not lose everything, but you do leave money on the table. Let's go through each wave, one by one. Wave 1. The positioning phase, when the money hasn't arrived yet, but the market is already moving. At this point, the law has been passed, the schedule has been set, but the real money is still sitting quietly on paper. For most people, this is the phase where nothing has happened yet. But for large institutions, this is actually the most important stage. The reason is simple. The market does not wait for the money to arrive before reacting. It reacts to expectations about the money. When large funds, investment banks, and trading desks read the capital flow schedule, they begin adjusting their positions, quietly, without announcements, just gradual shifts. At this stage, defensive assets begin to weaken. There is less need for shelter as uncertainty fades. Meanwhile, growth-sensitive areas start to stir. Not because earnings have already improved, but because the forward-looking narrative has changed. What matters most here is psychology. Vague fear, the thing that keeps money on the sidelines, begins to dissolve. It is not excitement yet, but relief. And it is precisely in this no one is paying attention at zone that the largest divergences are usually created. One notable detail is that volatility declines. As the schedule becomes clearer, the market, which hates uncertainty above all else, starts to breathe easier. No good news is required. Less ambiguity alone is enough. Wave 2. Personal tax refunds. Money reaches consumers' hands. This is the wave most people think of when they hear the word stimulus. About USD 1.2 trillion is refunded directly to households, with the average amount per household exceeding $8,000. More importantly, this year the money arrives earlier than usual. When money hits personal accounts, it does not behave theoretically, it behaves very practically. People pay down debt. They breathe a sigh of relief. They think about things they have postponed for months. A significant portion goes toward paying off credit cards and auto loans. This may not sound exciting, but it frees up purchasing power in the months that follow. Another portion goes into discretionary spending, a postponed trip, a kitchen renovation, a computer that is far too old. And a non-trivial share is saved or placed into investment accounts. What is interesting is that money rarely sits still. Even when people save, that money often flows into the financial system, where it continues to be reallocated. History shows that such direct cash injections create short-term but powerful boosts in consumption. And this time, the scale is far larger than in previous examples. Not because people suddenly become more impulsive, but because the amount is large enough to change behavior. At this stage, corporate profits improve not because of any miracle, but because real money is moving through the real economy. Wave 3. Corporate capital repatriation. Money returns. But for what purpose? The third wave is more technical in nature, but its impact is very deep. More than $2 trillion in cash that US corporations are holding overseas is encouraged to return home under preferential tax rates. This is not a story about patriotism. It is a balance sheet story. When the money comes back, companies must decide how to use it. And history shows that most of it does not immediately go into long-term investment. A large portion is used for share buybacks, reducing the number of shares outstanding. This does not cause companies to produce more goods, but it makes each remaining share more expensive. Another substantial portion goes into dividends. These steady cash flows are extremely attractive in a low-interest rate environment where fixed income becomes less appealing. The remainder is allocated to mergers and acquisitions, and a smaller portion to real investment. The last time there was a repatriation tax holiday, the scale was only a fraction of this one, yet the impact on the market was very clear. This time, with a much larger scale, amplification effects are hard to avoid. What should be noted is that this is not money that evaporates quickly. It tends to anchor itself within the financial system, lifting asset price levels over a longer period. Wave 4. Accelerated depreciation and a surge in capital investment. The fourth wave is discussed less often, but it may be the most durable driver. When companies are allowed to fully depreciate investment costs immediately, instead of spreading them over many years, their behavior changes very quickly. Instead of waiting, they spend right away. Machinery, equipment, software, infrastructure, automation, energy, supply chains. Not because they suddenly become more optimistic about the future, but because the tax system makes delaying less efficient. When costs are recognized immediately, the benefits arrive immediately as well. This creates a wave of orders, jobs, and demand for raw materials. Copper, steel, aluminum, energy all benefit as capital investment accelerates. And in an already tight labor market, price pressures begin to form. History shows that each time business investment rises sharply, related industrial sectors tend to outperform for a meaningful period. This is not a one-quarter spike, but a prolonged cycle. Wave 5. Inflationary effects and asset inflation. The final wave does not arrive immediately, nor does it have a specific date on the calendar. It is a consequence. When a large amount of money flows through an economy that is near full employment, inflationary pressure is difficult to avoid. But what is noteworthy is that this inflation does not necessarily show up clearly in everyday bills. It shows up most strongly in asset prices. Stocks rise faster than incomes, real estate rises faster than wages. Hard assets such as gold, silver, and energy become attractive as ways to preserve purchasing power. And here a troubling paradox emerges. When markets rise sharply, many people feel poorer. Not because they lose money, but because they do not own the things that are rising in price. This is when divergence becomes most pronounced. Not between the skilled and the unskilled, but between those already inside the asset system and those standing outside it. And when this cycle lasts long enough, a policy response will eventually appear. But that is a story for a later stage. What matters at this point is understanding that these 5 waves are not separate. They overlap. And it is precisely this overlap that creates the greatest momentum for the market. But there is still one more missing piece. One perspective that, if overlooked, causes the entire picture to become distorted. And that is where we need to turn our way of thinking around. At this point, the story may sound fairly straightforward. More money comes in. The market gains momentum, asset prices rise, a familiar cycle. But if we stop there, we will miss the most important part. Because the truth is, not everyone benefits from a strong rising market. This is where many analyses stop too early. People talk about indices, about percentage gains, about market capitalization evaporating or swelling. But they rarely talk about the real-life experience of those standing outside. Imagine it like this. The market rises by 25%, real estate surges, stocks set new highs, but your income barely changes. On paper, the economy is better. In real life, everything feels further out of reach. This is not a paradox. This is how the system works. When large flows of money enter, they are not distributed evenly. They move first into places that already have the structure to absorb them. Asset markets, the financial system, the balance sheets of those who already own capital. Those who are not present there do not have money taken from them, but they are left behind. In other words, a strong bull market can also be a quiet redistribution mechanism. It does not require a crisis. It does not require a recession. It only requires time. And this is the part that makes many people uncomfortable, because it does not resemble the familiar stories of winning or losing. You can do everything right in your personal life, but if you stand outside the flow of assets, the gap still widens. That is why the question is no longer whether the market will rise or not. The real question is, where are you standing within that structure? To answer this question more intuitively, we need an image, a metaphor simple enough to see how the entire system is actually operating. Imagine the economy as a massive, automated irrigation system. At the center is a reservoir, where water is pumped in according to a schedule. From there, the water flows through large pipes, then gradually branches into smaller channels, winding their way into every area. The plots of land closest to the reservoir are always watered first. The water arrives early, steadily and forcefully. Plants there grow quickly, lush and green, making it look as though the entire garden is flourishing. But the farther you move from the source, the weaker the water pressure becomes. In some places, the water arrives late. In others, it comes only in a few drops. And in some areas, the land is almost dry, even though the reservoir at the center remains full. Capital flows operate in a very similar way. When trillions of dollars are released, they do not spread evenly all at once. They flow first into the largest pipes. Financial markets, large corporations, places that already have the infrastructure to absorb capital. Only then do they gradually seep into the broader economy with varying delays. This is not a conspiracy, nor is it a flaw. It is the design of the system. Money always follows the path of least resistance. It seeks out liquidity, profit potential, and mechanisms that amplify its impact. And this is the key point. Your position in the system matters more than the speed of your reaction. If you stand close to the source, you feel the flow very early. If you are far away, you only see the consequences, when the water has already soaked into someone else's land. Understanding this metaphor will not make you rich overnight, but it helps you stop wondering why everything seems better while you yourself do not feel that way. And precisely because capital flows operate in this manner, there is a warning that needs to be stated, not to create fear, but to set the right conditions for what may come next. At this point, it is very easy to slide into two familiar extremes. One is to believe that everything will unfold perfectly, that the market will simply keep moving upward without any meaningful obstacles. The other is to fear that some kind of catastrophe is inevitably waiting ahead. Both ways of thinking oversimplify a system that is inherently complex. The reality is that there is no certain scenario. There are only conditional scenarios. If the USD 4.7 trillion in capital flows in while inflation remains contained and interest rates continue to ease, then asset markets may be able to sustain their upward momentum far longer than many expect. In that case, the feeling that everything is fine could persist, and optimism may even seep into areas that are usually the most cautious. But if price pressures begin to return, not necessarily in gasoline or food bills, but in stock prices, home prices, and hard asset prices, then policy responses become a critical variable. At that point, assumptions built on a cheap money environment may need to be revised. There is also another possibility, one that is discussed less often. If consumers become more cautious, if they use most of the money to pay down debt and to save rather than to spend, then the money does not disappear. It simply changes direction. From the consumer economy, it flows back into the financial system, where it continues to push asset prices higher. And finally, there is always valuation risk. When expectations run too far ahead of reality, markets tend to self-correct. Not through an immediate crash, but through periods of tension and volatility that easily force out those who are unprepared. The warning here is not, don't participate. It is this, do not confuse a favorable environment with certainty. Capital flows create opportunity, but they also magnify mistakes. So instead of trying to guess the final outcome, the more reasonable question is, throughout this process, which signals should we be watching in order not to be swept away by emotion? When faced with a chain of conditional scenarios, the familiar reflex for many people is to try to call the top, call the bottom, or find the perfect timing. In reality, however, those efforts rarely produce a durable advantage. A more effective approach is to read signals, not to guess outcomes. There are 3 key signals worth monitoring during this phase. The first signal, real consumer cash flows. Not optimistic statements, but behavior. Are people spending, or are they pulling back? Do retail sales, travel, and services revenues reflect the flow of tax refunds or not? If money is truly moving into everyday life, it will leave very clear traces, often before aggregated reports are widely released. The second signal, how companies behave with cash. When capital is repatriated, what companies choose to do with it says a great deal. Are they aggressively buying back shares or cautiously holding cash? Are they increasing dividends or postponing plans? These decisions reflect the level of confidence in the corporate sector better than any speech ever could. The third signal, the gap between asset prices and the cost of capital. When assets rise faster than changes in interest rates and incomes, the system begins to stretch. This is not a sign of an immediate collapse, but it is a signal that requires close attention. This is often when markets become more sensitive to negative news, even if it is minor. These 3 signals do not give you absolute answers, but they give you context. And in an environment rich with capital flows, context matters more than prediction. There is no need to react hastily, nor is there a need to stay completely on the sidelines. What matters is knowing what you are watching and why, because in the end, the biggest question does not lie in the market. It lies within you. Let's pause here for a moment before thinking about any strategy. If over the next 2 years the market rises another 20 or 25%, but your income remains almost unchanged, would you call that growth or inflation in another form? If home prices, stock prices, and asset prices continue to pull further ahead of wages, will the sense of stability you currently feel still exist? And an even harder question. Within this system of capital flows, where are you standing? Close to the source, where the water flows strong and early, or at the end of the pipeline, where you only see the results after everything has already been allocated? There is no right or wrong answer for everyone, but asking yourself these questions already places you in a different position from the majority. The position of someone who is observing the system, rather than merely reacting to it. If you have thoughts, or if you see signals that you believe others are overlooking, share them in the comments. Because sometimes, the most important clues are not found in charts, but in the lived experiences of those moving through this cycle. If there is one thing you should take away after this video, it is not a stock ticker or a specific prediction. It is a way of seeing, a way of viewing capital flows as a process, not an event, and a way of viewing the market as a system with its own internal order rather than a series of random fluctuations. In the next video, we will go deeper into a more practical question. How do large institutions manage risk when major capital flows begin to move? Not through big bets, but by adjusting positions, locking in profits, and avoiding the common mistakes that cause many people to be forced out midway. If you want to continue following this analysis series, no sensationalism, no hype, just a focus on how the system actually operates. You can subscribe to the channel so you don't miss the next parts. And if this video has made you see the market differently, share it with someone you think is also trying to understand what is really happening. Not to persuade them to do anything. Just to ask the right questions a little earlier. Because in major cycles like this, the advantage rarely comes from knowing more than others. It comes from understanding earlier and knowing when to act and when to stay still.